because chai is also tea in some languages. So today we are here with Jun from Stakefish and Sacha from Kaiko. Maybe you two can introduce yourselves a little bit further and explain what exactly we'll be talking about today.
Yeah, that sounds good. Thank you for having me, Molly. Hi, my name is JK. I'm leading the strategy and operations at Stakefish. Stakefish is a validator for proof of stake networks. On proof of stake networks, rather than miners, you have validators that are securing the network, and we are primarily running these validators through our cloud infrastructure and also bare metal infrastructure. And today, yeah, I've brought some interesting topic around staking ratios and how they've affect price, or maybe vice versa, or maybe there's no relation at all. And I'll dive a little into that in a bit.
Thanks, Molly, for having us. A pleasure to be here again today. And so I'm Sacha. I work at Kaiko, where we do market data for all the cryptocurrency infrastructure. And very exciting to be here today to speak about staking. I used to do I did some projects on the economics of mining, so I'm also very interested in the staking aspect.
All right, so let's get started. June, do you have some charts or presentations to share with everyone? Oh, wait,
Yeah,
one more thing I'll say, sorry to interrupt. If anyone wants to ask a question to anyone here, you can go to coinmarketcap.com/chat/cha-cha-chats. You can go to our Twitter page, or you can go to our YouTube channel, and I will be looking for questions and give you guys a shout out. Continue now.
Yep, awesome. Let me just share my screen. And while I'm doing that, let me just mention that I am drinking ginger tea, which is very good for your throat. Let me try to, hopefully everyone can see my screen. So yeah, today I brought two interesting metrics that I wanted to share, which is first staking ratio and price. Of course, price is a very important metric for everyone, but what a metric that people might not be as familiar with is the staking ratio. Now, staking ratio is simply how much of the entire tokens are being staked on a proof of stake network over the total number of circulating supply of tokens. And what this really means is that how many users are actually locking in their tokens to actually provide security to the network. But also, it also means that you're losing liquidity by staking. And so you're effectively signaling that you're long-term aligned with this token and don't plan to sell or trade it in the short, say, 1 to 2 months in the short term. So proof of stake itself is fairly new, and there aren't a lot of networks out there that have been running for even over a year at this point. And so that's sort of the reason why I brought Tezos, because it is one of the longest running proof of stake networks and has a lot more data points that we could start looking into and see if there are any relations between staking ratio and the price performance. And so today I brought this chart, and it spans from January 2019 to July 2020, which is about a year and 6 months worth of data. And you could see on the left axis, it's showing the staking ratio. You could see that Tezos has a fairly high staking ratio, ranging from 60 to 80%, a bit over 80% during this time period. And of course, Tezos price has appreciated a fair amount during the same period, from around 50 cents to around $3. And there's of course a lot of volatility throughout that entire phase. We could right off the bat see that as staking ratio increased during this time period, it increased by around like 32%. Prices have also increased as well. And there's definitely, the correlation sits around at 0.89. And so you can see that there's a strong correlation between the staking ratio and price. And so going back to my initial statement about how staking could signal that a holder is long-term aligned and wishes to hold the token for a long time, sort of sits along well with the appreciation in price. But of course, this does not necessarily mean that one cause is causing the other. We are in a bull market, to be fair, and so therefore it's perfectly plausible that of course, if a network is running longer and longer, there will be higher staking ratios, and maybe because it's a bull market, prices have coincidentally increased as well. So it might be just pure coincidence that these two are trending together, but it's just interesting to note that there is a strong correlation between these two. And that's sort of like the big picture of how staking ratio and prices are trending, but diving a bit into a bit more detail here. Let me go to the next one. Yeah, and so I've started to then sort of chop up these periods a bit more to try to see, if we look into more, more cut up periods, whether or not things correlate with each other strongly. And when I look at the periods of where the staking ratio has increased strongly, consecutively, has shown strength consecutively. The prices have performed very, very well during that same period. For example, looking at the first period, you see staking ratios have increased 16%, and prices have also followed that trend, along with the second period as well. And I don't know if this is also pure coincidence again, but the ratios of how much staking, how much the staking ratio has increased and the price performance, those two ratios seems to correlate pretty well. So there might be something interesting here. Again, not causation, but still something to look out for in the future performance of these two metrics. And then I have dotted this box for the last period because the staking ratio is still somewhat in an upward trend. We'll see where it settles for this final period right now, but it is still an upward trend. So I'm not really drawing the box here and saying that this period has ended. It might be still upward trending slightly bit more. So what this means is that as more and more people stake, that signals that more people are trying to hold for the long term, and that means that there's less sellers out in the market, and so the price has performed very well along with the increase in staking ratio. And so that's sort of like the narrative that I'm starting to preemptively draw here. We'll see again in a year's time whether this still holds up then. Now let's look at something different. Let's look at what happens when there's a sudden drop in staking ratio. And when you're staked, you lose liquidity. And so if you want to trade suddenly the tokens that you're holding, you want to sell them for whatever reason, whether you want to liquidate a bit, you want some cash, you would need to unstake. And so that's what I'm trying to observe here. I'm trying to observe whether when people unstaked and sent their tokens to exchanges, what that did to price. And obviously I expected the price to decrease, and unsurprisingly, this narrative does hold up pretty strongly. So 4 out of 6 times when the staking ratios dropped by more than 1% compared to the previous cycle. So in Tezos, the staking go on by cycles. There's this period called cycles, and the staking ratio data I've pulled are for each cycle. So after if the staking ratio dropped by more than 1% from one cycle to another, I observe how the prices performed during that period and the 2 weeks afterwards. And 4 out of 6 times, prices decrease along with the drop in staking ratio. And on average, the prices decreased by 21%, which is a quite substantive amount. And so I think there's definitely a strong, there's definitely somewhat of a causation relation here. And I think this is worth really exploring. So the 2 out of 6 times where the prices did not drop together were these 2 dotted circles. But you could also see that there might be something different going on here, because it's only a slight dip, and then the staking ratios recover, right away afterwards. And so therefore, it might be just maybe a data discrepancy, or maybe some of the wallets just moving around their tokens to stake in another wallet. And so while it's not 100% sure that's what's going on, but it could be explained as such. Whereas the other 4 times where the staking ratios have dropped, these are actual drops that have sustained at least for a few cycles. A few cycles. And yeah, so that's sort of some of the charts I wanted to show you guys, and then some of the conclusions I've drawn from these charts. I think still, let me just emphasize that I think it's still a bit early to draw any conclusions, but I do think seeing huge drops in staking ratios does signal somewhat that there are people trying to sell their tokens. And so there might be some interesting more dynamic analysis that could be done on other proof of stake networks to see if this holds up elsewhere.
Very interesting. Would you know? Do you remember the time interval that elapsed when you look at these fees and the dotted circles, how much time does it take before the staking ratio goes back up?
So this is just so like these data points are pulled by each cycle, which goes on for 21 days. So so that means that like right afterwards, it's just pumping right back up. Oh, sorry. Let me go back. So each cycle is 3 days. So after 3 days, it just went back up, recovered right away. And so it's a very, very quick recovery in staking ratio.
Mm-hmm. And what do you think for the other drops? What do you think could be causing that? Is it somebody withdrawing the funds? Do we have, is there a way to have a look at this on chain? I mean, how would you approach that?
Yeah, definitely. Definitely you could go on chain to view these. I have not, I have not personally viewed these and brought these, try to find out why these addresses are, moving funds away. But rather, regardless of the reason, if you see any of these drops, the conclusion I'm trying to draw is that regardless of what the reason might be, if you see these drops, it might be a signal that someone is definitely trying to sell for some reason.
Mm-hmm. And do we know about the fragmentation of the staking pools in the Tezos infrastructure?
Do you mind elaborating a bit on that?
So on the mining side, usually there are big concerns about mining pools being not very much fragmented and having few mining pools having a lot of the hashing power. And in staking, there's in addition a couple of vulnerabilities which you want to avoid. So how does that compare for Tezos? How is because you have to have a minimum of a couple, what was it, 8,000 coins to be able to bake. So how does that compare? How are people delegating their coins, and what do you think is going to happen in that?
Yeah, so it really depends on how you define the centralization in this front. There's still a lot of debate on whether you need to look at that from the validator level. Whereas I personally view it at the token holder level because it's very easy to switch your validator service, honestly. And so therefore validators pretty much hold very little power in my opinion. But going back to, answering your questions, it is still a bit more decentralized, I would say, than mining, in the sense that mining pools right now, around 3, 4 control most of the hash rate on Bitcoin and even on Ethereum. Whereas, even if you aggregate 10, 12, 15 validators on Tezos, you still will not have the similar amount of power as you would on, proof of work network.
Yeah, that's a great advantage of proof of stake systems, provided you can keep this heterogeneity of the system. And also, could you touch maybe a little on the inflation rate, or as you see the price increasing or the staking ratio increase, what do you think? Why are people staking? They have an opportunity cost, right? Because if they could just use the coins and do something else with it. What is this opportunity cost, and does that have any relationship with the inflation rate, you think?
Yeah, so the biggest opportunity cost of staking is like liquidity, like without a doubt. Once you stake, you lose liquidity. You're actively saying, "Hey, I'm planning to hold this for at least a month or plus." But conversely, what that means is, so on proof of stake, these rewards, these new inflation, new coins that are being printed are dropped to people who are staking, and so. Therefore, that means that if you're not staking, you're getting diluted in a sense. And if you're planning to hold a token on a proof of stake token for at least even 6 months to 3 months, you are going to get actively diluted if you're not staking. And so that's the reason why holders who plan to hold at least over a few months should stake. Because elsewise your share of the entire network is just decreasing by the minute.
Yeah, that's very interesting. Yep.
I have some questions from the audience.
Yep.
For June. I'll start with one from Protocol Politician on our CMC chat. And Protocol Politician asks, How does this compare to external factors? For instance, does Bitcoin rising or falling affect Tezos more than internal factors like staking ratio?
Yes, that's definitely fair. Definitely looking at this from using rather than US dollars, using a BTC price might show something different. But I haven't prepared that chart for this session, but I could say I could say that I had gathered that data, and the narrative does somewhat hold still, nonetheless. But yes, you're perfectly right in that the limitation of these charts is that there's a lot of external factors that are still not accounted for here. And so, yeah, if you include sort of how the overall coin market, overall crypto market is performing, maybe things look different. But at least when I looked at it initially, it did look like this narrative does still hold up, at least with relation to the crypto market performance.
So another question from the CMC chat, user generated money asks, could you control or exclude staking drops caused by big incentive offers and other staking pools?
Can the audience elaborate on that a bit more? Because I guess
yeah,
I'm
user
not
generated money, if you know. I mean, I think what he or she is trying to say is that maybe the staking drops are caused when staking becomes more lucrative in a different pool. And actually, this was a personal question I had about this, so I can ask mine and you can answer both. Is in the news this week, there were a few articles saying that the rise of DeFi and yield farming is the death of Tezos because Tezos staking has become just too small in terms of how much return you get. So I guess could you address my question and user generated money's question?
So in my opinion, these are totally different products, if you want to call it. Getting these staking participating in staking, getting staking rewards on Tezos is not comparable to actually actively earning yield. No one should be staking on Tezos just to get those staking rewards. It makes zero sense. Because if the token price does not perform or stay equivalent during that same time period, you might as well just have kept it in USD or BTC during that time frame. And so I view these as very, very different products. Staking on proof of stake networks means that you're trying to not get diluted, and you're just trying to make sure that the network is more secure. Those are the two only reasons you would be staking on a proof of stake network, not necessarily to get more yield on your money. And so I understand. I mean, Tarun also put out like a very good article around staking, reward rate versus yield, about how this might be a risk. But in my opinion, these are two entirely different products we're talking about, and have very different risk profiles. As an example, if any of these proof of stake networks like goes bonkers and the staking reward rate gets broken and everything just goes down, it's quite likely that the protocol team will try to do some sort of rollback or some sort of update on their code base such that we're back to square one where no one is actually getting actively hurt. Whereas on yield farming, if that blows up, good luck. You better have insurance because you're not getting that money back.
Yeah, I mean, I think that yield farming carries a risk that Tezos staking doesn't at this point in time.
Very, very different risk profile.
So here's another user question from, again, Protocol Politician, who asks, could we apply the idea of staking and price correlation to Ethereum too? For instance, could we look at the amount of potential Ethereum 2 stakers to guess at Ethereum's price?
Maybe not guess price, but maybe predict out sort of the selling pressure, I think is possible. Because you'll definitely have a lot less liquid tokens out in the market that are actively trading. But the one thing about ETH2 though is that you're not able to withdraw during phase 0, and this is probably going to mess up some of the market, how the markets will work. And so I don't think you could extrapolate what's happening on Tezos or any of the other proof of stake networks to what might happen on ETH2. That's the my biggest concern about extrapolating any of these staking dynamics elsewhere to ETH2. the fact that withdrawals will not be enabled on phase 0.
Yeah, and another thing to be careful about also is, when you have trending theories which are not stationary, you need to be careful about what those gradations mean.
So just another one, this came up earlier in my research, is that Tezos is also looking to expand to kind of capture that DeFi wave. So they just added Harbinger oracles to Tezos, which are signed price feeds that just allow for real-time prices to be for the creation of loans and collateral and protocols. Like, what is this? Could you explain it to the average person, and explain like why this could help Tezos catch the DeFi wave, if I'm interpreting what they're doing correctly?
Yeah, it's so imagine DeFi right now in Ethereum without Chainlink. It's very, very difficult. B, it means that each team probably would have to build up their own oracle. I know Compound and Maker has somewhat done this, but imagine every single team having to have done that. It takes a whole lot of amount of time and effort. And we operate Chainlink nodes, so we know how much work it goes into just even operating, feeding, ETH to USD exchange rate on chain. And just imagine having DeFi teams actually build that on top of the DeFi product is a huge, huge ask. And now on Tezos, finally, no oracles existed. And, of course, DeFi teams are now starting to pop up, but like there weren't any oracles. And now with the introduction of an oracle solution, possibly, that means that for DeFi teams who want to build on Tezos, there's one, tech stack that they would need to worry about less. And so that's why it might be the beginning of DeFi sort of, blossoming on Tezos, but we'll see. It's still early stages for now.
Yeah, it's been a very exciting development, and we've been working with the Tezos team at Kaiko to provide this kind of oracles. So we do provide price feeds on the on-chain, and yeah, I'm sure as you might have experienced, you need to be running nodes and making sure that you're embedding the correct information at the right time. So there's a lot that is involved in providing a secure and reliable price feed. But it is crucial for any smart contract or DeFi application. So it's very good development, and we're very excited to see what Whirlpool will build on top of that.
And is this in any way related to the Staker DAO platform? Which is I just see as another move towards DeFi, but I'm not sure how far that's been developed.
Yeah, Staker DAO is tackling something slightly different than I would say DeFi on the popular DeFi on Ethereum these days. Staker DAO is specifically what they're trying to do is bring on the staking rewards from different POS networks, and then bring that onto like the participants of that DAO. Yeah, I'm trying to think of something equivalent on Ethereum, but I'm blanking out. I don't think there is anything equivalent on Ethereum to this date.
Interesting. I have another audience question. So, Protocol Politician, our favorite question asker of the day, asks, is looking at changes in staking ratios similar to changes in hash rate on a proof of work chain? We know hash rate change is a lagging metric, right?
Yeah, good point. Possible. I know it's, I'm sorry, I can't really make any conclusive statements, but it's just the fact that like we have the reason why I've been able to bring on Tezos here today is because it has the longest data, and the longest time data we're looking at is only a year and 6 months. Imagine looking at Bitcoin data for its first year and 6 months. Probably none of the metrics really, provided a whole ton of insight. So, I would say try to imagine something similar here. It's possible. I mean, the narrative does make sense, right? If there's any change in staking ratios, it will, like, as an example, the staking, ratio drop, or maybe a huge staking ratio increase. It does make sense that the prices will be either, negatively or positively affected. But again, not enough data points to really conclusively say this as strongly as on for hash rates.
Yeah, and that's why you might want to look, at staking ratio differences and see how that impact lag price differences as opposed to just the absolute level. And that being said, I guess if the underlying assumption is that by increasing the staking ratio, you reduce the liquidity, and so you thereby get what's called a liquidity premium. You basically change the supply curve. Then there could be ways to think of this being a reliable metric, and then you have people maybe taking this into account into the price. Back to proof of work systems, the thing that you don't get in staking is if proof of work, if you want to increase the hash rate, if you don't have the facility, you literally have to go buy physical hardware, put it in a warehouse, connect it, turn it on, and start, do all sorts of tests. So typically what you see with the hash rate is there is a lag. I don't remember. I think it's the order of a couple hundred days between price changes and hash rate changes, which you don't have as much in the staking ecosystem.
Just to add one more thing here, I did try out lag by 1 cycle and 2 cycle, up to 2 cycles. Doesn't really significantly change any of the correlation factors that I've calculated. And so maybe you got to try more lags, but at least I've tried a lag 1 and lag 2, just FYI.
Interesting. We have a few more minutes left. I will give a shout out to a YouTube watcher, Andrea D. Michelle, who asked no question, but put 2 hand waving emojis. So a shout out is deserved for that. So I'll just tell everyone that's watching, if you have any last questions, send them in as I continue with Protocol Politician, who just posted, to continue the proof of work analogy, electricity and chip size are some constraints on hash rate. Are there similar constraints on proof of stake chains?
On Tezos, somewhat, because on Tezos there is a self bond rate, roughly at least. So for a validator, a lot of people will stake their coins with a validator. Of the total amount of stake on a single validator, at least 8% of the total coins staked on a single validator needs to be owned by the validator itself. And so there is that sort of capital constraint, but it sits at around 8%. So it's not entirely big. And also, if you look at other proof of stake networks, this capital constraint, doesn't even exist. There is no self-bond sort of rule. And so I'd say there's not as much constraint as on proof of work.
All right, well, that seems to be the last question. So Protocol Politician says thanks. So we're nearing the end of our 30 minutes. So maybe you guys can say any final words, and then if anyone wants to find you on social media, how they can do that.
Yeah, thanks for having me today. It's definitely fascinating to look at some of these staking metrics. A lot of analysts in our small group have tried looking at these different metrics, and still, we do believe it's still a bit early to try to draw conclusions, but it's still interesting to look at them nonetheless. And yeah, I'm really looking forward to more analyses around the staking, especially with ETH2 staking around the block. If you want to reach out to me, you could find me at Proof of JK on Twitter. Or definitely visit stake.fish, our official website, and you'll find our links to Telegram, where I'm pretty active as well.
And thanks, Molly, for having us. So always a pleasure to be here. And I think it's very exciting to see the proof of stake ecosystem grow. And we've been talking about proof of stake for such a long time. And now, especially with Ethereum 2.0 coming up soon too, it's I think those are very good times to be in. And you can follow me at sgheb on Twitter, and stay tuned for more announcements coming up on the Kaiko and Tezos Oracle systems.
Ooh. Yeah, thanks you guys. So everyone finish your tea. Everyone that's watching, have a cup of tea next time you're going to do some on-chain analysis. Mine today was with lemon and honey because it's a little cold where I am. Yeah, I guess signing off. Thanks again, guys.
Awesome. Thank you.